Funding rates are one of the most brilliant inventions enabling a new primitive in the space. It basically creates an incentive for balance in a system, which allows you to effectively have the other third-party players come in and farm those funding rates while hedging themselves in the underlying market, basically running a sort of cash and carry trade, and manage the risk for you or for the platform, which then allows the platform to basically be non-custodial.
I was a tech investor in the hedge fund world and private equity world. And I think no matter what field you're in, two things you've said here that resonates is one, being a decisive decision maker and understanding risk management, the cost benefit of doing things and kind of stopping yourself out in an investment that is going wrong. And also on the decisive decision making, you're never going to get 100% of the data, if you will. So, the best investors actually are able to act and not have analysis paralysis.
You're taking a very different approach toward an idea that is a lot of US GDP, is a lot of historical markets. I mean, commodities are such a big part of kind of how the world has grown and financed itself. What are you building and why do you think it's as important as it is? Today, we're excited to have a very special episode of the Proof of Podcast. We've got two extremely accomplished guests on the podcast today. John Wu, who's the president of Ava Labs and, in a previous incarnation was the CEO of SharesPost and, is one of the pioneers in a lot of the financial innovation ideas that are coming out of the crypto space. And then on the other side, we've got Kaledora, who's today's guest, who's the founder of Ostium Labs. And funnily enough, was a classmate of mine almost 10 years ago when we were at school together and is building a really interesting project in the space right now. Her background is very interesting. She spent almost 10 years or a decade in professional ballet before she ended up going to Harvard, dropped out of Harvard for a while to pursue the ballet career, came back, finished up her degree, found her way to Bridgewater, and then eventually ended up in crypto building one of the more interesting ideas out there. So, we're really excited to have her on today. And with that, would love to get into it. So Kaledora, you've done so many amazing things. How do you actually make decisions or get conviction to do all these kinds of things?
First of all, just thanks for having me on the podcast. It's an honor to be on with both of you and super excited for this conversation. And thank you for the glowing recommendation. So I love the decision question. I think getting good at making decisions is like a lifelong quest, and it's especially important for a founder. And one of the, I think, tougher things like becoming a founder after ballet is that the way that you should optimize for making decisions is very different when you run a company versus when you're doing something like ballet that is like an art and a craft. It's sort of like a general approach to work, but also decision making, just to draw, I guess, to lay out the contrast, I think, explicitly. In ballet, you're very much focused on doing things sort of perfectly or approximating perfection or trying to get there. Whereas when you're building a company, speed is actually much more important than accuracy. So you're kind of like more running in a, ChatGPT, 80%, get there quickly, like get to 80% and, last 20% of perfection doesn't really matter, and try to just iterate quickly and make decisions quickly. That's actually something I can definitely say I've struggled with, and I've had to learn. I think I've gotten a lot better over the last year and a half, but learning how to make decisions quickly and be okay with them sometimes being wrong has been, I mean, one of the primary ways that my brain chemistry has like needed to change. And I've had to sort of force that on myself. On my general predisposition, how the framework that I've tried to build for making decisions has been initially going with intuition. And then if it's really substantive and the consequences are really high, as is obviously the case, if, choosing to quit or retire from the career that you've been planning for since you were 3 years old and make the transition and go back to college and leave all of that behind, retiring from ballet is obviously a major decision. Then I sort of let initial intuition guide me towards what I think might be right, or why I should even consider a different path, or like what the set of decisions is. And then I actually tried to be very calculating is perhaps not the right word, but very concrete about the trade-offs between those two, and thinking of it as sort of this like decision tree. This sounded kind of crazy when I talked to dancers about it, and I tried to explain, we operate in a tech world where making decisions, quote unquote, rationally, or trying to think of yourself or approximate rationality, which I think we're all always like, it's the rider and the elephant. If you've ever read any of the sort of like pop psych books about like you have an initial intuition, then your rational mind tries to post hoc justify that. I think we're all sort of doing that, even if we think of ourselves as rationalists or approximating rationalism. But certainly among dancers, the idea of trying to be rationalist is even itself considered crazy. And so I had a lot of dancers look at me like I was a crazy person when I described my decision process for quitting ballet, which was like, this is a branching path. I can either do this for the rest of my life and choreograph and try to direct and just continue trying to become as excellent as I possibly can in this field, or I can make a decision. I can decide to pursue something completely different, which is entirely unknown to me. And if I choose the latter, which I had basically made a decision about that was going to be the path I was going to go down at some point. What is the optimal time for me to retire? And the way I sort of framed that was like I drew on a piece of paper for my director, like a graph that was the opportunity cost of not going back to school and restarting my life was like increasing exponentially. And the marginal benefits of staying in this one career that might teach me a lot, but where the skills weren't directly translatable into my potential next career was declining. And I was kind of like, we're somewhere near the intersection and probably a little bit before the intersection, but not quite past it. And I'd rather quit now. That was basically how I made the decision about at least the timing and when I decided to retire. And it turns out that the decision was even better than I could have anticipated, or the timing was, because a year or 6 months later, COVID hit. And the last 6 months of my ballet career were the best. I had already, handed in my resignation. I was, I think, enjoying myself and dancing better than I ever had in my life because I gotten rid of this sense of being judged or of really caring about being obsessed with the outcome rather than the process. And if I had decided to retire a year later, I would have missed out on those last precious 6 months. And because, no one was performing. So yeah, intuition followed by some sort of, I think, simple framework around like rational decision making around like the timing of that decision and what the potential consequences are.
I mean, you say a couple of things that really resonate. Prior to being an operator, I was a tech investor in the hedge fund world and private equity world. And I think no matter what field you're in, two things you've said here that resonates is one, being a decisive decision maker and understanding risk management, the cost benefit of doing things, and kind of like stopping yourself out in an investment that is going wrong. And also on the decisive decision making, you're never going to get 100% of the data, if you will. So, the best investors actually are able to act and not have analysis paralysis, because especially in the investing world, by the time you decide if you're going to wait for all the data, you've kind of missed out already. And even in the operating world, you're still operating with limited data. I know we're in the world of AI now and it's all about data, but it's really the mental algo that you can use to make decisions with imperfect information that really sets apart people. And you call that tuition. It's a combination of tuition, good decision making, but also over time with the experience, you're able to make that much better decision.
Yeah, I want to just add one thing onto it, which I think is like I've like tried to convey this to my team. I don't know if anyone from my team watches this, whether or not I've done this successfully, but I think like what's really important also when you're managing a team or leading a group of people is getting them to understand that you're not going to make every decision right. I think there's like some element of self-judgment or like obsession with perfection that you can get rid of, but getting other people on your team or people that you work with to understand that they also have to get rid of that for both for themselves, but especially in how they analyze your decisions, I think is important. And I think when you're, yeah, when you're like anyone on your team, or if you work for someone else, you have to just trust that the person at the helm making like the most substantive business decisions is just going to make 51% important correct decisions. Like they're not all going to be correct. A lot of them are going to be wrong, and that's also okay. But when you're especially when you're building a startup, you have to get comfortable making decisions quickly, and at least for the ones that are reversible to some degree, it's better to just make more of them, and some of them will be wrong than to get, all of them perfect and do far fewer or make far fewer.
How do you think about some of the biggest decisions you've made, Kaledora, since you started? What do you see as the most important sort of couple of moments on your journey to be where you are today in the crypto space?
I mean, the first one was starting a company. That was totally intuitive. That was not a calculated decision at all. It was like incredibly impulsive, if I'm being completely honest. I met my co-founder when we were freshmen, my second time as a freshman at Harvard, and we became very close friends. We started trading together, just basically doing the process of intellectual discovery together. He was like, we were just basically intellectual, like learning partners. Like we took a lot of the same classes in college. We fell down the crypto rabbit hole together. Basically, like everything we sort of know about the space, we learned together. And we had toyed with the idea of starting a company together for some time. And we decided pretty impulsively to apply for like a fellowship program while we were still in college. This was Soma Capital. They're like a non-crypto accelerator. I honestly just like saw this on Twitter. I saw that they were handing out, they were doing their first fellowship program. They're giving out like 100K to kids in college to like explore an idea. And I was like, we're still in school. Like, I already was supposed to start my full-time job at Bridgewater, a couple months later. He was still in college. He had over a year left of college. I saw it on, I should go back and find the text and screenshot it and save it, because in case my iMessages ever disappear, I remember sending him the link to the post on Twitter that was like, we're opening our first fellowship program, anyone come apply, you can be pre-idea. And I was like, we're applying to this. I already decided, period. And like, that was the beginning. Obviously, we had a million different ideas that we were toying with. We knew it would be in crypto. We knew it would be something in DeFi, but we had no idea what it would be. That decision to at least start working on something, obviously there were many smaller decisions along the way that were like, all right, are we actually doing this? Am I like actually turning down my Bridgewater job? Are you actually dropping out? Are we really going to build this? That was a series of decisions, but I think those were actually a series of like smaller decisions from the initial completely impulsive decision that was just based on, we've been talking about this for a while, we should just apply and we should try to start something.
How do you guys resolve things when you differ?
I think thankfully we actually don't disagree on that many things. I think we disagree like really, really constructively. We're like really comfortable battling it out and like actually just like really actually like aggressively battling it out on stuff if we really disagree on something. But there has never been something where it's been like an intractable disagreement. I would actually say the place where we disagree the most is more on a way of approaching idea generation or approaching decision making rather than like a specific. Yeah, I don't think we're insanely dogmatic about some particular element of the field that we can't bridge that gap. I would say actually most of the disagreements have come from these like differential ways in which I think we approach like coming up with new ideas. And I would broadly characterize that as, I tend to emphasize more the importance of having context and knowing what other people are doing in order to know where you should fit in and what your decision should be and where you should position yourself. I describe this as, being in a submarine and like someone is manning the deck and kind of coming up with new ideas or something on how to manage the submarine. And someone else is like the radar and sort of like scanning the ocean or like, holding the flashlight, scanning the ocean for what's ahead and what should you be doing and where's a coral reef or something, or where's another submarine. I tend to care a lot more about that, which I actually think sometimes, which is dangerous if you don't have someone who's the opposite. You see this so often in crypto where people are constantly pivoting and constantly trying to reposition themselves with some new dominant narrative rather than creating their own narrative or just sticking to their own vision of the future that they want to see come true. But I think that the way you position yourself and the way you take in like external market information and update your priors is super, super important. And he tends to come more from this like wanting to genesis or like wanting to come up with ideas from first principles, which makes him truly brilliant. Like he's truly brilliant at coming up. Like he's the most creative person I know, incredibly creative, incredibly technically creative. But the downside I think of that sometimes is that we've spent time maybe like reinventing from first principles things that if we had spent like a dozen hours or something on like market research or on like reading other stuff, we would have, maybe not needed to reinvent from first principles. So I think like that, usually the disagreements come from me being like, hey, you haven't looked enough what other people are doing before you insist on me to go this direction. And him being like, you're copying, you're trying too hard to like think about what other people are doing, like have some conviction in like our way of doing it. And usually we come to some agreement based on which way we were leaning more in that particular conversation. I think like a healthy tension between the two is very important. Otherwise, you fall into one or the other of the two sort of like mental entrapments.
Yeah, no, makes total sense. And having a strong co-founder is kind of everything at the end of the day. If your co-founder is someone who has your back, it just makes the journey so much easier. Look, what you're building is really interesting too, and I want to spend a lot of time talking about it. Maybe I'll frame this in a bit more of an open-ended way because you're taking a very different approach toward an idea that is a lot of US GDP, is a lot of historical markets. I mean, commodities are such a big part of kind of how the world has grown and financed itself. What are you building and why do you think it's as important as it is?
We are building DeFi perpetuals infrastructure for real world assets. And that's sort of a blanket term, but what that means at launch is FX, commodities, so both metals, energy, and some agricultural commodities, and then indices. But ultimately, the North Star is every liquid market on Earth. We want to be the platform for onboarding those assets through what is effectively a synthetic product. So it enables people to take on price exposure without needing to own the underlying asset. You mentioned commodities. Commodities were the sort of original inspiration for what we were building. I can talk a little bit more about that story and how we got there. And also I would say a lot of the technical challenges that we face have been specifically related to onboarding commodities because of how the underlying market is structured. Very briefly, what I mean by that is, so if you want to create a perp on an asset, what you need is a market to match. This is an oversimplification, but you need a market to match buyers and sellers. You need a funding rate. You need a spot price. Getting the spot price for FX is fairly not necessarily straightforward. There's more complexity there, but there is a spot FX price. Getting the quote unquote spot price for something like WTI oil is a different story. When people are talking about spot oil, there's not really a liquid spot market. They're not actually talking about spot. They're talking about a rolling 12-month future. And so getting that price is more complex for assets that trade primarily through futures, and where that is the reference price people are talking about if you're trying to create a synthetic on it. That's what I mean by sort of like where we spend a lot of our technical energy, is actually trying to optimize the product for being able to include commodities with these unique features. But ultimately, the vision is sort of not just constrained to commodities, but rather ultimately to be able to onboard any market for which we can get a reliable price and can generate a market to have that on chain and be sort of settled in USDC or in any other stablecoin as we have today. To give a user, like anyone listening, for like a sense for what this actually looks like substantively, this is, you can go onto the application, you can go long or short with or without leverage on any asset on Earth. You can trade it like it's a perpetual. So basically taking the primitive that we think is, or I think is like demonstrably what really has product market fit in crypto, which is trading. And then specifically the primitive, or the asset type that has the most product market fit, and we see has grown to be sort of the dominant primitive, like non-spot primitive in the space. And then applying that to every other asset and making every asset tradable as a perpetual. And not, as I said, sort of reiterating, starting with the FX, commodities, and index markets. One sort of bit of context that I want to provide, which we can talk more about if you want, is if you talk to old school FX guys, they'll tell you this sounds a lot like something that exists, or that perps actually sound a lot like some of the markets that exist in the traditional markets. These are basically like synthetic cash settled markets that are the primary way that like consumers or like non-institutional investors access trading more generally in a lot of jurisdictions, which is basically this sort of like synthetic product where they don't own the underlying. The core difference is, and I wrote about this a little bit in a thread or something that we could maybe share in the show notes, but the core difference is that there's no funding rate in that system, in that traditional market system. And so there's no incentive towards balance, which means that there's no incentive for anybody else to take the other side if all the open interest is skewed long or is skewed short or something on some asset, which effectively means that the platform itself needs to balance, to manage its own risk and to balance the book, which means that it needs to be custodial. The difference with what you're doing is we think that actually the introduction of the funding rate, and I, at the risk of beating a dead horse on the funding rate side and being a total nerd about one particular fee structure, I really think funding rates are like one of the most brilliant inventions enabling like a new primitive in the space. It basically creates an incentive for balance in a system, or like either across a pair or cross pairs. We can talk more about some ways in which you can have like cross pair funding rates, but that's for another time, which allows you to effectively have the other third-party players come in and farm those funding rates while hedging themselves in the underlying market, basically running a sort of cash and carry trade, and manage the risk for you or for the platform, which then allows the platform to basically be non-custodial rather than some individual sort of broker or platform managing its own book and soliciting liquidity providers or other banks or some outside player that they have to integrate within their own platform to manage that risk. So hopefully I didn't go too off topic, but I think there's we see this as being not only a fundamentally like new primitive for crypto users, in the sense that we're bringing these assets that don't exist in any form on chain today. Like there is nowhere you can trade natural gas. There's no way you can trade copper. People have experimented with gold. Obviously there's like Pax Gold, there's XAUT, there are other gold products, but for most of the assets where we're focusing on, there is nowhere to get price exposure or to trade these assets on chain today. So not only offering new assets to on-chain capital that is, quote unquote stranded or doesn't have any way to get exposure to more diversifying assets, but also disrupting the sort of broken primitive or broken market structure in the underlying market, that by introducing sort of these crypto primitives or crypto market structure tools to create a fundamentally like new setup that can be non-custodial and can give like more confidence to the users and the people who want to trade those assets.
I think it's a great service that you're doing to create a non-custodial perp market in these commodities, especially for the retail. So by definition, this is going to be very retail focused. Do you worry about how different jurisdictions have different takes on regulation and what licenses you need and KYC for wallets and all of that? And how do you balance all of that?
Yeah, so it's a great question. I would maybe just preface by saying it's a synthetic protocol, so we're not tokenizing anything. Like we're not holding any underlying assets. As I mentioned, it's non-custodial. It's all USDC settled. So You were never like minting there's no like minting of some token that is supposed to represent Tesla or like copper or like some contract. So it is all synthetic and like virtual price exposure, which I think is like very, very core to actually answering your question. And so that means like I would sort of characterize what we're doing as largely in the same category, or at least analogous to what a lot of other on-chain or like decentralized perpetual platforms are doing, where again, they're not custodial, they're not holding user assets, they don't have control over them, and they're not, purporting to have some sort of minted token that mimics the underlying without necessarily a market mechanism to ensure that that's the case. As far as jurisdictions, I just want to be very clear. This is not directed towards or like usable by US users, and we do exclude people from restricted jurisdictions. And we are targeting a non-US market. And I really mean that. Like, I think a lot of people say that. If you look at the traditional market analog, where are retail FX platforms based? And when I say retail FX, just to be clear, people usually use that as a blanket term. Most of those platforms are servicing not just FX, but they're servicing commodities, indices, often single name equities. They often have thousands of assets on their platforms. They're sort of referred to it as blanket term as like FX trading platforms. All of those platforms are ex-US. They're all servicing non-US customers, and there are tens of millions of international consumer users who are using these platforms on a daily or a monthly basis and are outside the US. So truly, if you look at the distribution of like the sort of customers that we're looking at, we're not sort of wink, wink, nod, nod, like looking at US people. I think we're actually focused on this market that is outside. And then in terms of, I think your more general question, so this is definitely something that we're looking at and exploring. I can't really give any particular context explicitly here in like a public venue, but that's definitely something that we're exploring. But at least initially, the product is, as I said, non-custodial, cash settled, et cetera, and will be not available in restricted jurisdictions. But there's a further direction that we're looking at there that we're, I think, in the early stages.
That's great. That's a smart way to do this, I think. Kaledora, you've been really good at expressing the benefits, like you said, the funding rate and all of that, and on Twitter and using X as a platform to express the benefits of what you're doing at Ostium. Is that by design, or is that part of your marketing strategy, or to create awareness?
I'm really flattered that you think I'm doing a good job. I hope so. Like, I hope every day people think that like what I'm saying makes sense and it resonates in some way. I think definitely in the last couple of months, there've been like a few posts that have really taken off. I think, I don't know, depending on your standard, at least by my standards, and that people seem to really resonate with. So I'm flattered to hear you say that. I don't have a huge following or anything, so I don't know that I'm any sort of social media guru. Maybe in 6 months I will be, or I'll have more to say about that. Look, I would just say one of the most important things that you can do as a founder is write more. I think actually Keone from Mana had like a post on this the other day, and I commented, writing more is one of the most most useful things I've done in the last 4 months. I used to have this sort of block, actually very related to what we talked about in the very beginning of the podcast, around like perfection and like optimizing for speed and quantity rather than doing each thing perfectly. I used to have this mortal fear of saying something on the internet that would be perceived as like not being entirely true, or like could be pointed to as like, this was not correct, or like you changed your mind on this. And I actually think I've, especially in the last 6 months, sort of like reformed my view about what is my role as like a communicator or figurehead of some sort for the company. I need to actually be sharing my thoughts. There's so many thoughts that I've had over the last year and a half where I like missed the way for being able to express it. Things that I thought 2 years ago that I just didn't share because I wasn't entirely sure if they were correct, or like how I was like 70% sure about my view, but I wasn't 100% sure. And I was like, like hold off until I'm like really sure about this thing before I say something. And then like 3 months later, everybody else is talking about it. And I'm like, damn, like I missed my shot to be one of the first people to talk about this thing. Or like my view evolved, but evolved in a way that it would have been helpful for me to have described my prior views so that people could follow along and see how it had shifted. And I basically tried to throw away all those fears and just sort of trying to treat it more as my real-time diary for what I'm thinking and why other people should care. And that has seemed to work 10 times better than trying to have like a perfectly structured manifesto at like time T and then like updating that 6 months later or like a year later. I mean, yeah, if you're a founder and if you're anything like me or anything like I used to be a year and a half ago, like just write more. And like if it's really stupid what you said, you can just delete it. It's okay. No one's going to judge you. Also, don't be afraid of like ripping yourself, like your prior self off. Actually, John, the other John Wu from previously of Aztec, he's sort of brilliant at, I think, writing on Twitter. He told me this. You also shouldn't be afraid of like ripping your own self off. Like if you say something in the past that like did really well, and then 3 months later you want to just say like the exact same thing again or reiterate it in a different way, so few people are going to be like, you said this before, like this isn't new. Like no one's tracking that. No one actually cares that much. If something resonated, you should just restate it in a new way. And so yeah, I've tried to just
And
do
that's a
more of
great
that.
point. And the other John Woo I know well as well. He's a great guy also. He's also a fellow HBS person. He is really good at writing as well. And I think what
Yes.
he and I talk about is when you write things down, you really cement your thoughts and
Yes.
it helps you achieve better conviction actually. So when you put something down, the figurative paper or online these days, you really cement thoughts and it actually induces action as well.
I I completely agree. And I would also say maybe one other piece of advice for anybody, again, just with the caveat that like I am no expert, but this is what has worked for me. If you tend to have writer's block or you get stuck on things you have this like again penchant toward trying to say it perfectly. What I found to be useful is don't be biased against your own ways of or like be committed to one particular way of being creative or writing things. The pinned tweet thread on my Twitter that's like, 20 tweets long. I honestly labored over a course of like weeks and like just like little pieces, bits and pieces here and there that I like threw together. And then the whole thing came together in like a 1 hour or like a 30-minute period at like 3 a.m. when I was like hunched over my computer and I said I was going to go to bed 3 times, then I didn't. But like I wrote it over a very long period. Whereas I think tweet that I wrote most recently, like while I was at ECC, that I think did well. I wrote literally after coming started writing while at Rave and like finished in the cab home from Rave. Completely stream of consciousness, like didn't write it on Apple Notes and then put it on Twitter. Like it was pure on my phone, tweeted like hunched over, like at Rave, like in the car and like sitting on my bed in the hotel at like 3 a.m. And then I just like pressed send. I didn't really double or triple check anything. So there are different ways of being creative. There's no one single right way. And it's also okay. You can change over time. Sometimes you'll be really like labor over something. And sometimes it'll be stream of consciousness and it'll work well. I think both can work.
Very cool. Now in Ostium, I think what differentiates you guys is a couple things. One, you guys are very smart about incorporating traditional assets and to give you a little bit differentiator from the other, call it perp products that are already out there. The other thing I think you guys have done, and to talk about it a little bit to the extent you can, the competitive advantage of the oracle that you guys have done in order to make the real world asset or the traditional asset something that can happen on Ostium.
Yeah, I love this question, John. I love talking about this. So okay, so I'll talk a little bit maybe about the Oracle first. So we spent a lot of time trying to figure out where to source prices for this stuff. I said this earlier, but I'll reiterate. A simplified model of how to build a perp on something is you need a market to match buyers and sellers that can account for the features of that market. The account for the features of that market is a very important parentheses or caveat because how you account for the features of the FX market or the commodities market if you're creating a perp on it is very different from what you would do for crypto. That requires sort of specialized infrastructure, but largely you need a market to match buyers and sellers and to aggregate liquidity. Two, you need a funding rate, which we've I think already talked at length about. And three, you need a spot price or some reference price, perhaps. If, as we discussed earlier, the spot price for a lot of the commodities is not actually really the spot price. It's like a rolling front month future. So I can talk more about the market structure and we can get into that, but I'll just focus on the sort of pricing because that's where the Oracle part comes in. Really, none of the existing Oracle players out there today are equipped or have focused most of their energy or any of their energy on creating high performance oracles for real world assets. And that's not a discredit to them by any means. It's simply that's not where the market has been. And that's not necessarily where the demand has come from, where it's hard to validate the demand for people wanting it if there's nowhere to trade it currently. How do you know if people want it or if there's no way to trade it in the first place? And most of the infrastructure, I think most of the innovation on the Oracle side has focused on new consensus mechanisms across nodes or new ways of ensuring, the price is tamper proof, all of which are important innovations, but are fundamentally different types of innovations that are innovating on where do you source the data? How do you aggregate the data? Like that, the first is like a blockchain infrastructure question. It's like, how do you build it's like a consensus mechanism. It's a blockchain infrastructure question. And the latter is a traditional financial market data problem. It's like, can I get my data from the CME? Yes, no. Can I get my data from a market maker? Yes or no. How many data sources do I need? Which contracts are they referencing if I'm referencing CME data? How do I account for out of market hours? should be my standard for outlier exclusion? What do I do if I'm skipping from referencing one contract to referencing a different contract? Is that reflected in the price report or not? These are the sorts of questions that someone, certainly, who like spent years at like Bloomberg or at these like traditional market data companies, would also be like better equipped to answer than us. But we were sort of the only, I don't know anybody else was sort of sitting at the intersection of like trying to figure out traditional financial market data and having a very specific need on the like blockchain or like DeFi side, and like sitting at the intersection of that. So we just tried to solve it ourselves. And really most of the infrastructure, maybe the second piece I would add there is like, even if you can solve for those and it's not trivial, or like, and none of the, again, like most existing oracles are not focused on trying to solve that, actually being able to have infrastructure that is flexible enough to account for the solutions to those problems. So one example is what you do with out of market hours is like, none of the oracles are really set up to like be able to, at least out of the box as they were when we spoke to them, to be able to account for the solutions to those problems. So I'll mention the out of market hours one as our example. The traditional, or like the status quo for some of the experimentation with real world assets has largely been to like either block trading on the front end. So if like you don't get a market price, you just sort of block trade, like you don't allow the front end UI, just like prevents you from submitting a trade because the market is quote unquote closed. Or to do things like basically overriding the oracle price and setting it to zero, which can work, but also is risky if you're doing it at like the node level and some of the nodes report zero, some don't, you could get worked out, or some other sort of hacky solutions. And I won't say that our solution is perfect, but I think it's a better solution than anything that's out there today, which is basically that we move the market hours data to the node level and we include that as one of the parameters in the price report. So instead of having to just, having an oracle price and sometimes there's just no price at all, or sometimes the price is reported as zero. Instead, it's, well, you do always get a price. The oracle continues to produce a price, every second or sub-second. But included in that price report is some Boolean. There's some statement about like, is the underlying market open or closed? And then we store all the data on IPFS on a per asset basis that like each of the nodes can access. So that allowing you to be able to do that requires you to be able to have like one for each of the nodes to be able to pull in that market hours data in a reliable way. Two, to have like an aggregation logic or consensus logic across the nodes that is able to account not just for the price. So it's not just like medianizing across all the nodes, but can also account for the market hours. If so, you medianize across 10 nodes, but then half of those nodes are saying the market is open and half of the market is saying the market is closed. Like, what do you do? Right. So you need to have some consensus mechanism or some agreement across nodes that can account for that other piece of information. And then you need to have a price report structure that can account, that like includes that information about whether the market is open or closed. All of those things are deeper down in the infra level. So you first need to like decide how would you want to solve the financial market data question or financial data question, and then figure out what does that require at an infra level, and then put those two pieces together. And there's nowhere out of the box today that can do any of this stuff. One thing I maybe want to add there is, so I would describe the stack on the Oracle side, if you're doing a pull-based Oracle, is like relatively modular. There's how you source the data, how you aggregate the data, how you agree across nodes, how you generate a price report, and then how you verify the price report, because you're not by default pushing a price on chain. You're like producing a price report, and when you need it, you're pulling it selectively on chain. Where we thought we had, earned secrets, or we had like unique requirements, was like where to source the data, where to aggregate the data, and the price report, but no insanely super strong advantage or thoughts on like what the consensus algorithm should be, or like what the verifier contract should look like. And so for that sort of part of the stack, we leverage Stork Network. I don't know if you're familiar with them, but they're an Oracle that started out on Starknet, and now they service many of the chains, including Arbitrum. A lot of the perpetexes there. They were incredibly flexible and basically willing to work with us on creating a bespoke solution. So they do a lot of the node management for us. We didn't want to manage and run nodes ourselves in-house. We thought it introduced like a bias and centralization risk that we didn't want, even just like from day one. So they manage and run the nodes, and they run the aggregator, but we produce we source all the underlying market data, and we sort of wrote all the code for like how the aggregation logic should work. So I would say it's like an in-house Oracle managed node operated by Stork to minimize centralization risk and minimize bias.
Are there any assets that you started out with, or how many assets have you now broadened to?
Yeah, so on testnet, we have 19 assets, 2 of which, by the way, we also leverage Chainlink, not to ignore them either, but on the crypto side, we leverage Chainlink's data streams. So that's like the new low latency data streams product, which is, again, a pull-based sort of Oracle. So They launched that on Arbitrum earlier this year and like late last year with GMX. And we do leverage their price feeds for real world assets. So for crypto assets, for Bitcoin and ETH. And were we to list many other crypto assets, we would leverage Chainlink. So we use Chainlink data streams for those two assets. And then on the other RWAs, we have 17 of those, which currently it's like G10 FX. So it's euro, pound, and yen. We have a bunch of metals. We have gold, silver, palladium, platinum, and copper. We have energy as well, WTI, Brent oil, natural gas. And then we have a couple non-US indices. So Hang Seng Index, the Nikkei. And then we have some soft commodities, mostly for the memes: soybeans, lean hogs, cattle, and cocoa. Those fees are a little bit less reliable, and so we'll probably have to hold off until we have more data sources for some of those more mutable commodities. But for most of the other assets, those will be live hard as well.
Well, I think just perfecting the gizmo on how you get prices through your own Oracle methodology is important because you have a big head start on other people. The next step is you must have, I mean, I think some of your investors are natural market makers as well in terms of bringing liquidity to these. Do you have market maker partnerships, and how are you thinking about going to mainnet with those market makers?
So our system, for context, it's like a pool-based and perp. So there is no order book proper, which also is better from like a decentralization perspective. There's no need for some entity to run an off-chain order book. So you can think of as the pool basically acting as a like prop market maker. So this is why we like call these like market making vaults. They're basically extending taker liquidity to any user that wants to come in and get execution at a price that's coming in from the Oracle with some small spread, and extending that taker liquidity, and then basically acting as the counterparty or taking on that directional risk if and when it exists. And then you can think of this as like asynchronous matching almost, where through the funding rate, we incentivize market makers or prop funds, whoever wants to run a basis trade, to take the other side of that trade, balance out the open interest, and then minimize the risk for LPs or sort of that market making vault. And if they don't want to minimize their total directional risk, and then hedge out that exposure on the underlying market. So very similarly to the way people ran this sort of strategy on, a GMX, or you could even do on a DYDX, where you might be collecting funding and you hedge out your exposure on Binance or Bybit or wherever it is, you would do the same. It's just the other leg of that trade. Well, the two legs of the trade are on Ostium, and the other leg is not Binance, but would be an interactive brokers or an LMAX, or it could be even the CME potentially, depending on where you're able to pipe in. Or more recently, it could be a Coinbase futures, because they just most recently listed gold and oil futures, which we see, I think, as very validating of our thesis of this like increased convergence between crypto and macro, and sort of the cross listing of traditional market assets on crypto venues, and opens up again the ability for anyone running that sort of trade to hedge themselves on a venue that they're already plugged into if they're a crypto native prop fund or market maker. So that role for someone running that, I would say there's more flexibility. We don't need to have some name XYZ market maker running a market making strategy on soybeans to list soybeans. So the benefit of the current model is that we can basically expand to longer tail assets without needing explicitly someone to be quoting prices on that, because the prices come from the Oracle, and basically the vault is taking that exposure and is rewarded with all the liquidation rewards and a majority of trading fees. And you can think of that as sort of uncorrelated, like an uncorrelated bet on the rest, like not on the rest of the crypto market, in the same way that like sort of like as a hedge to like a GLP style holding, right? Where you're you as an LP in that market making vault are actually taking on counterparty exposure to a bunch of non-crypto assets, who can act as a means of sort of more diversifying. But we need then people to be running that sort of like basis trade.
That's great that you mentioned also, recognizing that Coinbase has their perp market that they're trying to develop as well. They're more institutional based. They have licenses, I think, in Bermuda. Would it be, even though yours is more retail based, I guess, are you looking at partnerships to like bring together more liquidity, so to speak, from institutional liquidity?
Yeah. So this is something where I think we're very excited about, and there's nothing I can share right now. I think we're still in sort of the workshopping phase, but a lot of these, there are a number of firms that basically operate sort of in the background of these traditional market platforms that I mentioned earlier in the pod on the liquidity side. So that are basically taking on the trades that are routed to them from platforms that offer liquidity to retail, and then need to manage their book and route that to basically to like often to like a prime broker. And that is sort of like how they manage their book. Those platforms, many of them are increasingly taking on a similar role with sort of centralized crypto platforms and helping manage like that liquidity cycle, I think is still something that we're working through. But there will be very interesting opportunities for these like cross-platform arbitrage and for reimagining that liquidity cycle from like retail or like sort of consumer liquidity to institutional liquidity through extending that to other asset classes through like what we're doing. Hopefully it's like not a convoluted answer, but I think the the model like in crypto, the way things have evolved, like as on-chain platforms have evolved to allow people to like enable perpetual exposure and you start people starting to see doing this like cross-platform arbitrage strategies, we see ourselves bridging that gap where we'll enable like new types of cross-platform arbitrage strategies, but now not just like on crypto assets, but also on these traditional market assets. And so bridging the players that are currently playing some role that have like some digital assets team, but are also heavy hitters, I guess, in like the traditional FX space, getting them to sort of manage that like liquidity cycle is, I think, at the crux of like unlocking the change in the role that we play in those markets rather than remaining relegated to some corner of DeFi.
Look, Kaledora, you have this really interesting thesis around perps. I think you call it the perpification of the world. People within crypto are very focused on tokenization. Can you tell us a little bit about the perpification thesis and, what the implications are for how you're building your platform and where it's going to go?
Yes. So this is my tongue-in-cheek term that sort of started out as a tongue-in-cheek response to tokenization after doing enough like tokenization and RWA panels and being like, I need a word for something that to encapsulate what we're doing as distinct from tokenization that is also snappy. So perpification is what I came up with. Seems to have some staying power. I've had a few people quote it back to me. What I mean by that is basically a perpetuals first approach to onboarding non-digital assets on chain rather than tokenization, which tokenization implies you have some off-chain holding company, basically taking like the Circle or the Tether model and applying it to all other assets. So you have some off-chain holding company, you hold the asset, you have a minting and redemption process. That asset then exists in some tokenized form on chain, is freely or non-freely tradable on chain, and then you can redeem that for the underlying asset through that or some sister holding company. I think that has worked obviously extraordinarily well for stablecoins and has also worked well for a lot of yield-bearing assets like treasuries. Why? Mostly because if people want to use something as a means of exchange, they need like an ERC20 token, the equivalent on other chains that represents that asset that they can use as that means of exchange. Or if it's a store of value, is the case for yield-bearing stable that they can again hold and sit on, and is providing them with yield, and also that they can in theory like self custody. But for most other assets, people mostly want to trade them. Like the interest, I think, in trading or like punting with or without leverage on, oil is far, far greater than like just sitting on oil for some indefinite period of time or like using oil as your stable coin or something. So when we sort of like looked at the space, we're like, all right, all of the focus is on basically this like one approach to onboarding non-digital assets, right? Like what is actually going to get this to the next, I hate this expression, like the next billion users, the next 1,000, the next 1,000,000 or whatever it is, number of users, what is actually sort of like net new and what better services the needs of like also services the needs of the existing user base on chain. And I say that because I don't think anybody has effectively built a crypto primitive or like a DeFi product that didn't first service users who like already have a wallet and are already doing stuff on chain. I think to reach scale, you need to have like a use case that is appealing to people who are not doing stuff on chain today. But you have to start with something that services some need or like is useful in some way to existing on-chain users. Otherwise, you're really just like shooting yourself in the foot in terms of go to market. So what are people doing on chain today? Okay, they're trading. What do they like trading? They love trading perps. What is a great primitive that has proven to be is like a fundamentally new primitive that is like crypto native, also perps. And then basically putting all those pieces together, we see this like perps first approach or this like synthetic approach to onboarding these assets as a better alternative, not only because it better caters to like what people are doing on chain today. We also think it is more closely related to like an underlying market that we want to disrupt based on all the stuff I discussed previously. And it is like a much more crypto native primitive. It rather than sort of importing a lot of the market structure issues of the underlying market, it leverages this primitive and like infrastructure set that has been battle tested over the last 5 to 7 years in crypto and applies it to other assets. And the last way to sort of like tie that bow together, right, is like Schiller, perps were not invented and, like by BitMEX, like Schiller had written about these like in the 80s. They've been the idea of like a never non-expiring perpetual future has existed for 30 plus years. And I think like crypto has been the ideal testing ground or experimental ground for seeing if that could work. And like it has worked, like really, really worked. And we see this as a necessary step in the evolution of a primitive crypto is pioneered, while also obviously being, we think, like the preferred way or the way that better suits the sorts of assets that we're trying to onboard. So that's my rant about perpification. We think perpification will outpace tokenization. We think it'll be, not that I think like tokenization won't happen for a lot of the assets that we list, but I don't see a world in which the demand for like sitting on natural gas indefinitely outpaces the demand for like trading and like punting on natural gas or like punting on the Hang Seng Index. It just seems so unlikely to me. And so I think we're reaching like the end of the sort of marginal like improvement curve on tokenization, like, extending that to other assets. And I think we're entering hopefully what will be the golden age of perpification for real assets.
That's awesome. Well, when that term goes viral, we'll make sure to credit you on the back end. Last
Good.
thing, guys. So if we want to spend 1 minute or 2 minutes here, would love to do a quick lightning round where John and I maybe each ask you two terms and you give us maybe the first sentence that comes to your mind in response. John, why don't I let you go first?
Okay. Layer 1.
Layer 1. Layer 0.
Only one answer here, Kaledora. There's only one answer.
I mean, Ethereum. I don't know what I was supposed to say. I'm sorry. Okay, Avalanche. Sorry, Avalanche.
Kamala Harris.
Coconut.
Ryan Selkis.
A lot of tweets.
Tokenization.
Perpification. Come on. That was a setup.
That was good, though.
Fair enough. John, do you have any more, or are we good here?
Yeah, I do. I have two more. How about I give one of your favorite ones, Deepin?
EV3.
Ah, I like that. EV3.
That's a good social clip right there.
And AI.
Perplexity. I was ranting actually with like my family the other day about how I think Perplexity has become my favored engine, LLM engine of choice over sort of vanilla ChatGPT. I like that they let you choose your foundational model. It's better at citing sources. Yeah, Perplexity has become my best friend.
Favorite book?
I'm actually, I actually brought this over. I didn't know if I was going to quote it, but I actually brought it to my desk. I'm reading this book right now by Danny Meyer. It's called Setting the Table, and my amazing roommate, I mean, she'll be really happy to get this shout out, gave it to me as a birthday present just over a month ago. And I've been trying to do a little bit of reading. I like have not been reading at all as a founder since I started the company, but I'm trying to take like one day a week where I don't look at my phone as much and I read something. And I've been reading this book. It's incredible. Like I remember reading the Anthony Bourdain book as a kid, and I love this intersection of like business and food. And there's one quote that I want to read, which I think has an amazing echo to like the role of sort of like community and ecosystem in crypto, which is, this is about a restaurant. This is a restaurant book. A business that doesn't understand its raison d'etre as fostering community will inevitably underperform. So this is, I think, a lesson for all crypto founders. Everybody talks about community in crypto, and sometimes I think it's a little bit overhyped, but I actually think traditional market businesses have a lot to learn from crypto. You want to make people feel something, and they have to be part of something bigger than themselves for them to care. So yeah, that's my lesson from a hospitality book. I have a lightning question for the two of you.
Give it to me.
Give it to me,
okay. Kaledora.
Okay. And you're not allowed to answer Ostium. You have to be more creative than that. DeFi.
I think DeFi is a great petri dish for TradFi and to understand the benefits of decentralization and self-custody.
Yeah, real-time info is my response. All of that makes sense.
I like that.
Look, this was an awesome episode. Again, I think Kaledora, you have a very interesting way of looking at the world, and perpification is definitely something that I think we're going to be hearing a lot more of in the next couple of years. Maybe last thing, do you want to tell us and maybe our listeners where we can find you, and if we want to learn more about some of the stuff you're working on, where we might be able to go for that?
Of course. So you can find me. I'm at Kaledora everywhere. One of the benefits of a weird name. So you can find me on Twitter and Telegram. Please don't spam me if you find us. Please don't spam me on Telegram. You can spam my likes, I guess, on Twitter or my retweets. I'm fine with that. You can go to our website, ostium.io. We have a link to a blog with lots of interesting, hopefully, research that we'll be putting more of. We do sort of these like macro research bites, little mini blogs on stuff going on in macro and related to a lot of the assets that we have listed. You can also read our docs, and then you can deposit into our vaults, our market making vaults, which I referenced earlier. Those just launched last week at ECC. And then we are launching the full trading product at a redacted date very, very soon that you can look forward to in very short order. So yeah, that's where you can find us.
Well, we're incredibly excited with that. John, anywhere that people can find you?
You can look me up on X, John, the number 1, Woo. Please reach out there, or LinkedIn.
If the other John Woo's listening, that number 1 is there for a reason. Anyway, guys, really appreciated this today. This was an awesome episode. Thank you so much for the thoughtful questions and answers.
Awesome. Thanks, guys. This was so much fun.
Thanks for listening to the Proof of Coverage podcast. We'll be posting 1 new episode a week on Mondays, interviewing the best DePIN and crypto founders out there. If you like this episode, please follow us on Twitter or X at CoverageProved or on any major podcasting platform. Thank you.